Let me tell you something that is going to bother you. The trader with the smallest position size in the room is almost always closer to consistent profitability than the trader with the largest one. Not sometimes, almost always. And the reason has nothing to do with capital preservation, nothing to do with risk management formulas, and nothing to do with the conventional wisdom that says start small so you do not blow up your account. Those reasons are true, but they are surface level. They miss the actual mechanism. They miss why starting small is not a concession to weakness, but a deliberate act of psychological engineering that the best traders in the world understand, and that you, most likely, do not. I have spent decades working with traders at every level, from the person opening their first brokerage account to fund managers running hundreds of millions. And I can tell you with complete certainty that the pattern is always the same. The traders who rush to trade large destroy themselves. Not because the market punishes them, though it does, but because their own psychology punishes them in ways they cannot see while it is happening. And the traders who have the discipline, the patience, and the genuine understanding to start small and stay small until they have earned the right to trade larger, those are the ones who are still here 5 years from now, 10 years from now. Those are the ones who actually make it. Now, I need to be very clear about what I mean by earn the right, because this is where almost everyone gets it wrong. They think earning the right means having enough money, having enough screen time, having enough wins, having enough confidence. None of those things are what I am talking about. What I am talking about is something far more specific and far more important. You have earned the right to increase your position size when, and only when, you can demonstrate that the outcome of your last trade has zero effect on the execution quality of your next trade. Let me say that differently. When a loss does not make you hesitate, does not make you angry, does not make you tighten your stop, or widen your target, or skip the next valid setup. When a win does not make you overconfident, does not make you sloppy, does not make you increase your risk because you feel invincible. When you have reached the psychological state where every trade is executed with the same mechanical precision regardless of what happened on the trade before it, that is, when you have earned the right. And you cannot reach that state trading large. It is neurologically impossible. Let me explain why. Your brain has a threat detection system that is older than language, older than rational thought, older than any part of you that understands probability or edge or expectancy. This system, centered in the amygdala, monitors your environment for danger. And it defines danger broadly. Physical threat is danger, social humiliation is danger, and financial loss is danger. When you place a trade that is large relative to your psychological capacity, not your financial capacity, your psychological capacity, this system activates. Cortisol floods your bloodstream. Your heart rate elevates. Your field of attention narrows. And the part of your brain responsible for rule following, for systematic thinking, for the calm execution of a tested process gets overridden, not partially overridden, functionally shut down. This is not a metaphor. This is neuroscience. The prefrontal cortex, the rational, rule-following part of your brain, literally loses the ability to control your behavior when your threat detection system is fully activated. You do not make decisions in this state. You react. You move your stop because the pain of the loss is intolerable. You exit early because the fear of giving back profit is overwhelming. You revenge trade because the desperation to recover what was lost has hijacked every other priority. And afterwards, after the damage is done, you sit there stunned, wondering how you could have done something so obviously self-destructive. You knew better. You had rules. You had a plan. And none of it mattered. It did not matter because your position size put you into a neurological state where rules and plans become inaccessible. You were not trading. You were surviving. And survival has no use for your trading plan. This is why starting small is not a limitation. It is the solution to the most fundamental problem in trading. The problem is not the market. The problem is not your strategy. The problem is that your nervous system treats financial risk as a physical threat. And when the threat is large enough, it takes over. Starting small keeps the threat below the activation threshold. It keeps your prefrontal cortex online. It keeps you in a state where you can actually follow your rules, observe your behavior, and develop the neural pathways of consistent execution. I know what you are thinking. You are thinking that if the stakes are too small, the practice does not count. That you cannot learn to handle the pressure of real trading by trading amounts that do not pressure you. And this objection sounds logical, but it is completely, dangerously wrong. Think about it this way. A pilot does not learn to handle the stress of an engine failure by experiencing an actual engine failure on their first flight. They learn it in a simulator. Then they learn it at low altitude with an instructor. Then they learn it in progressively more challenging conditions, each time building on the neural pathways established at the previous level. At no point does anyone suggest that the simulation does not count because the stakes were not real enough. The training counts because the skills transfer. The neural pathways built under low stress conditions are the same neural pathways that fire under high stress conditions. The only difference is whether those pathways are strong enough to override the panic response when real pressure arrives. Trading is identical. When you trade small and follow your rules perfectly for 50 trades, you are building the same neural pathways you will need when you trade larger. The habits of checking your criteria before entry, of placing your stop without negotiation, of letting the trade reach your target without interference, of recording your execution quality after every trade, these habits are neurological. They live in your brain as physical connections between neurons. And those connections get stronger with repetition and weaker with neglect. Every time you follow your rules at a small size, you are strengthening those connections. Every time you break your rules at a large size, you are strengthening a different set of connections, the ones associated with panic, with impulsive action, with emotional decision-making. You are literally building the brain of either a disciplined trader or an emotional gambler, and the position size determines which one you are building on any given day. Now let me get very specific about how this works in practice, because I am not interested in giving you principles without procedures. Principles without procedures are just ideas, and ideas do not change behavior. Only practices change behavior. The first practice is what I call threshold testing, and it is the foundation of everything that follows. Before you trade anything, before you risk a single dollar, you must identify your current emotional threshold, not your financial risk tolerance, your emotional threshold. The maximum amount you can lose on a single trade without it producing any detectable change in your emotional state or your behavior on the next trade. Here's how you find it. You start at the smallest position size your broker allows. You trade your system with full rule compliance for 20 trades. After each trade, you record two things. Did I follow all my rules? And what was my emotional state during and after the trade? If you followed all your rules and your emotional state was neutral on all 20 trades, you increase your position size by one increment. Then you trade 20 more. Same recording process. You keep increasing 20 trades at a time until you notice that a loss produces a change, a hesitation on the next trade, a desire to skip a setup, a tightness in your chest when the next signal fires, an urge to modify your stop. The moment you notice any of that, any change in your behavior or your emotional state following a loss, you have found your threshold, and you stay there. Not temporarily. You stay at that level until the change disappears. Until 20 consecutive trades at that size produce the same neutral emotional state as the level below it. I know what you are thinking. You are thinking this could take months. You are thinking that at this rate you will never trade meaningful size. You are thinking about the traders on social media posting their six-figure months and wondering how you are supposed to compete by trading the minimum lot size for 20 trades at a time. Let me address that directly. Those traders on social media posting six-figure months, the vast majority of them are not showing you the whole picture. They are not showing you the blown accounts that preceded the screenshot. They are not showing you the drawdowns between the highlights. They are not showing you the leverage that makes those returns possible and those losses catastrophic. They are showing you the highlight reel of survivorship bias, and you are comparing your process to their marketing. Stop doing that. It is poisoning your psychology. The traders, who are genuinely, consistently, year after year profitable, are not posting screenshots. They are sitting quietly in front of their screens, executing their process with the kind of calm that would bore you to watch. They are trading a size they are completely comfortable with. They are following their rules without internal drama, and their account is growing, slowly and steadily, because their edge is expressing itself over a large sample of properly executed trades. That is where you're going, and the path to get there runs through small positions, not around them. The second practice. Once you have identified your emotional threshold and are trading consistently at that level, you begin what I call execution scoring. After every trading session, you give yourself a score from 0 to 10. But the score has nothing to do with money. It measures one thing: the percentage of your trading decisions that were fully compliant with your rules. If you took 5 trades and followed your rules perfectly on all 5, your score is 10. If you followed your rules on 4 out of 5, your score is 8. If you deviated on 3, your score is 4. The math is simple. The discipline of doing it honestly is not. And here is the key. You track this score over time, you keep a running average, and you do not increase your position size until your 30-day average execution score is above 9, not 8. Not 8.5, 9. Because anything below 9 means you are still deviating from your rules frequently enough that increasing your size will amplify those deviations into meaningful losses. This is the mechanism that professional traders use. Whether they articulate it this way or not, they do not increase their size when they have more money. They increase their size when their execution quality warrants it. The money is a byproduct. The execution is the cause. The third practice is the one that accelerates everything. It is the one most traders resist because it confronts them with exactly how far they are from where they think they are. After every trade, you write a single paragraph, not about the market, about you. What did you feel at entry? What did you feel during the trade? What did you feel at exit? What impulses did you have that you acted on? What impulses did you have that you did not act on? Let me give you an example so you understand the level of specificity I am talking about. Trade 4, shorted at the signal. Felt confident at entry, maybe too confident. The setup looked clean, and I caught myself thinking this one is a guaranteed winner. During the trade, price moved against me by 12 pips. I felt my stomach tighten. I looked at the dollar amount of the loss and thought about moving my stop up. I did not move it. Price reversed and hit my target. At exit, I felt relief, not satisfaction, relief, like I'd escaped something. This tells me my position size might be at the upper edge of my threshold. The relief response suggests I was more emotionally invested in this outcome than I should be. I will monitor this over the next 5 trades. That is the entry of a trader who is going to make it. Not because the analysis is brilliant, because the self-observation is honest, specific, and actionable. That trader knows what is happening inside them during a trade. They can feel the difference between appropriate engagement and excessive attachment. They are building the one skill that matters more than any other in trading: the ability to observe their own psychology in real time and adjust accordingly. You cannot develop this skill when you are overwhelmed by the size of your position. When the emotional activation is too high, self-observation becomes impossible. You cannot watch yourself panic while you are panicking. You can only watch yourself manage mild discomfort while you are managing mild discomfort. And mild discomfort is what small position sizes produce. That is the whole point. Let me talk about the timeline, because I want to set your expectations accurately, and I would rather give you the uncomfortable truth now than let you discover it through failure later. If you commit fully to this process, threshold testing, execution, scoring, psychological journaling, and you do it with genuine discipline and honesty, the typical timeline to reach a point where you can trade at a size that produces meaningful income is 6 to 18 months, not 6 to 18 days, not 6 to 18 weeks, months. The range is wide because everyone enters this process at a different point. Some traders have already built significant self-awareness. Others are starting from a place where they have never once observed their own emotional state during a trade. But the range is real, and the lower end requires total commitment. I know what you are thinking. You are thinking that is too long. You are thinking you cannot afford to spend a year trading tiny positions while your account grows at a pace that barely keeps up with inflation. And I understand that frustration. I have sat across the table from hundreds of traders who felt exactly the same way. But let me ask you something. How long have you been trading already? How many months or years have you spent trading at a size that was too large for your psychological state? How many times have you blown an account, or given back months of gains in a single week, or abandoned a strategy that was actually working because your execution was inconsistent? Add up all that time, all those months of emotional chaos and erratic results, and cycling between hope and despair. That is the cost of not doing this process. That is the cost of refusing to start small. The 6 to 18 months I am describing is not wasted time. It is the fastest path. It only looks slow because you are comparing it to an illusion, the illusion that you can skip the psychological development and still achieve consistent results. You cannot. Nobody can. The only question is whether you do the work now, deliberately and efficiently, or whether you spend years learning the same lesson through pain. Here is what I want you to take away from this. Not as a concept, as a commitment. Starting small is not the first step before the real work begins. Starting small is the real work. It is the environment in which your brain builds the neural architecture of a professional trader. It is the condition that allows you to observe yourself with clarity, to follow your rules with consistency, to develop the psychological resilience that separates the people who last from the people who do not. Your position size is not a measure of your ambition. It is a measure of your self-awareness. And the trader with the smallest position and the highest execution score is closer to freedom than the trader with the largest position and no process at all. Trade small. Score your execution. Observe your psychology. Increase only when you have earned it. This is not the slow path. This is the only path. Everyone who skipped it eventually came back to it. The only variable is how much they lost before they did.